Right, good morning everyone as we head into European trade on Tuesday the 29th of August. And we're back after a long weekend, bank holiday Monday in the UK yesterday. So it is a little bit of a Monday morning for markets. So I wouldn't go jumping straight into a bunch of trades first thing in the morning. It is kind of a 4-day week with markets obviously UK markets being shut. Well, not shut, but a lot of the institutions not trading yesterday, as a lot of them will have days off on a bank holiday Monday. So lack of liquidity, lack of volume throughout markets yesterday, meaning markets may take a little bit of time this morning to wake up. But we'll see that in about half an hour, how it opens up at the open. But massive upside in the FTSE this morning, which is maybe a little bit surprising, but there is some reasons for that. UK grocery prices have touched a 10-month low, or have increased at the slowest pace for 10 months, which is again another positive in the fight against inflation, which reduces the need for further interest rate hikes as the current interest rate hikes continue to take effect in the UK economy. That is seen as a positive for the FTSE, as markets had priced in more than what seems to potentially be needed. So solid upside in the FTSE. Apart from that, you see the Nikkei touches 2-week top on Wall Street boost again. The Japanese continue with their ultra loose monetary policy, which is positive for the Japanese stock market, especially when you take into consideration the interest rate situation across the globe, with many of the major economies, and pretty much all of the major economies, hiking interest rates aggressively to curb inflation. Then you look at the Japanese with still negative interest rates, yield curve control still in place, monetary stimulus still being provided to the economy, is a good recipe for some Nikkei upside as and when stocks push higher. But global stocks are under pressure. It's going to be tricky for the Nikkei, but global stocks are positive. The Nikkei is probably the horse to back. Oil trades flat as supply concerns offset worries over demand. There's a tropical storm off the US Gulf Coast. The eastern side of the US Gulf Coast may impact supply. You can get some storms and some hurricanes and stuff that can shut down oil refineries. Obviously, if there's some oil refineries shut down, it reduces the supply of oil, and then it's positive for the price of oil. But couple that with a difficult situation regarding China, plus interest rate hikes in the US, or potential for a couple more interest rate hikes in the US, may be a bit tricky for global demand. So we'll see how that plays out. We still got some high impact data this week from the US that will give us a further indication as to whether we get further interest rate hikes from the US. We got core PCE a little bit later on in the week. We do have NFP on Friday as well. So we'll do a video in a few hours reviewing the week, or look ahead to the week, and we'll break those data releases down in a little bit more detail now in a couple of hours. Australian New Zealand dollars find some support. Inflation test looms. The Australian New Zealand dollars got a reprieve from selling pressure on Tuesday, courtesy of a break in the recent run of bad news from China ahead of important inflation data due later in the week. But those currencies still massively under pressure. There is some inflation data from Australia tomorrow. Equity futures across the board slightly positive. Some stimulus measures from China in order to boost the stock market. You can see the Hang Seng up 2% in terms of the overnight session. So positive for Chinese stocks. In terms of being positive for the currency, I mean, the currency is sold off heavily. Increased stimulus measures normally negative for a currency, but the fact that the economy has struggled so heavily over the last number of months, maybe a bit of stimulus maybe isn't the worst thing for the currency, but that is more of a reason for Chinese stocks upside. So if I was going to back a horse off the back of that, I would rather back the Chinese stocks over the currency. But FTSE up 1%, as we were speaking about earlier on. Chinese stocks up 1% or a couple of percent, and then like the Asia Pacific index up 1% as well. So positivity in China, positivity in the UK for reasons that we've previously mentioned, and that has lended a bit of support across the board to equity markets as a whole. some downside in yields also lending a bit of support to equity markets. The fact that yields are continuing to the downside means markets are slightly unsure as to whether we actually will get another interest rate hike from the US. The more lower yields go off the back of expectations for interest rates not to rise further, and more positive that is for stocks. We've had a pullback in yields, pretty sizable pullback in yields. That has proved somewhat supportive for stock indexes, and as long as that continues, as long as it's not any safe haven flows and yields pull back, that should continue to be supportive for stock markets. US dollar pretty much across the board lower. I mean, it's flicking kind of even kind of squaring up against a couple of currencies, against euro, Swiss franc, Chinese yuan, flicking about at zero, but relatively negative across the board. Turkish lira, I mean, it's up against the Turkish lira, but Turkish lira massive strength the other day. That was a 7.5% increase in interest rates, which is obviously a sizable increase in the interest rates, and sent dollar lira through the floor. So it's a tricky currency to trade. I mean, I'm not sure I'd go trading that too promptly, but that is a reason for that. Australian dollar, Kiwi dollars, up off the back of a bit of positivity with China, plus stock indexes up across the board. A bit of a reason for a pullback, but you can see month-to-date percentage changes, 3-month percentage changes, year-to-date percentage changes. Those currencies have been hammered this year, or in terms of been hammered, I mean, they've been aggressively low over the course of this year. So those trends still firmly in place. A bit of upside today doesn't really change that in the medium term as of yet, but we do have some economic data out this week which could continue that move to the downside. Apart from that, pretty mixed across the board. Not much to see anywhere else across the markets. I mean, you can see Monday, not a great deal yesterday, obviously due to it being a bank holiday as well in the UK. Look forward to Tuesday. But a negative consumer confidence from Germany, but it's kind of negative anyway. Hasn't really shaken up markets too much over the course of this morning. Not too much out today really, as you can see, but this monthly CPI indicator, something worth keeping an eye on when it comes to Australia. The Australian inflation figures are a quarterly figure in that country, so this monthly CPI indicator gives you obviously a monthly reading of CPI, which consensus is for that to drop again further. Drops again below consensus, that further reaffirms no more interest rate hikes are needed in Australia as the trend continues to the downside, and that is likely to cause a fresh wave of selling across the Australian dollar. Inflation in Germany due to pull back slightly again. Month over month figure though seemingly remaining a bit sticky at 0.3%, which is still too high in terms of inflation from Germany. And then you're into PCE on Thursday, you're into some manufacturing PMIs, you're into NFP then on Friday, which we'll break down a bit more detail later on in the session. We can see the Aussie popping higher, Kiwi popping higher, Euro, Sterling over the course of yesterday popping higher, dollar Swiss, dollar CAD, dollar yen relatively sideways. You can see dollar index with a downside on that. You can come across the stock index where you can see the S&P, the Dow Jones, the Nasdaq and the Russell all grinding higher. You can see the DAX, the Euro stocks, the FTSE, DAX and the Euro stocks grinding higher, but the FTSE smashing higher, obviously due to the fact that I mean, if it's the first trading you've had in the UK, obviously bank holiday yesterday, back in today, first trading you've had of the week this week, but that goes in line with grocery inflation cooling down quite substantially as well. You can see these yields continue to push lower in the US. 10-year posting a kind of messy head and shoulders, but you're making an attempt through the lows down here. If that does get through those lows, that's likely to be supportive for stocks once there is no safe haven flows. Once there's no safe haven flows going in line with those yields pushing lower, but 10s and 2s making an attempt lower. But oil pretty sideways, as you can see here. Gold kind of grinding higher, but if these yields were to continue higher, I think dollar yen may be the trade. At the moment, you've had a failure. Let me say a failure. I mean, you're struggling to make fresh highs on this. You can see across there. You can see across there. You're just struggling to kind of make fresh highs, no matter what. No matter what time frame you're looking at. You can look at it on the daily as well if you want. A bit of higher time frame up here again. You're just struggling up at these highs again. 4 hour, you're struggling up at these highs again. I mean, no, you're just looking at the same chart, dropping down the time frames. But you did have a bit of a break, through this near term low here, which kind of invalidated this. Well, technically invalidated the uptrend, but was a bit of a bearish indication. If you do push lower from here, that would be probably a good trade to the downside. You can read that as a bit of a head and shoulders, a bit of a messy one, but I certainly will keep an eye on that type of a level in and across there. You can see a number of touches back here and a bit going on back here. So if these yields continue lower, which they look like they want to do, as you can see here, you get through these lows, that's likely to be negative for dollar yen and positive for the Japanese yen. So that's something that I keep an eye on. If you do get through those levels to the downside, something like that would not be out of the realms of possibility. So pull back in yields, that would be my trade off the back of that. Really, that's probably all you've got to go off today as of right now. Give it a little bit of time for markets to wake up. You don't want to be buying FTSE at these highs. You don't want to be buying Euro stocks or DAX at these highs. You want to back a horse, back the S&P, one of the US stocks, haven't you? But with the underlying potential for interest rate hikes to continue in the US, maybe it's not the best of ideas just yet. But having said that, if you woke up every day for the rest of your trading career and went long stocks, you probably wouldn't be too far off being profitable. So keep an eye on that. But pullback in yields would suggest some downside in this, but a pullback in yields is likely to remain supportive for stock indexes. Some upside in stock indexes to come if that continues on lower. So you're back in yields lower. My preference would be to have yields lower, long stocks, short dollar yen into today's European trade.